Hey guys, I'm Becky and welcome back to my channel. So today we're talking about IRAs or individual retirement accounts, or also known as individual retirement arrangements, less common name there. But basically an IRA is a tax-advantaged retirement account that is not sponsored by an employer, meaning you don't have to work for a company that offers a retirement plan that you invest in. It's something that you can do as long as you're basically bringing home money, you're bringing home income, then you can put into your own individual retirement account. The good thing about an individual retirement account is even if your employer does offer a sponsored plan, whether that's a 401k or 403b or a PERSI or some type of pension plan, you still have the option to invest into an IRA account, even if you are investing and maxing out that 401k. There's a slight catch with that though. It's based on your income levels and the tax advantage that you might get with the IRA aftermath, but we'll get more into that later. When it comes to retirement planning, I am a big supporter of taking all of the advantages that you can get. So all of those tax advantages that you get from investing into a retirement account, whether it's an IRA or 403b or 401k, take advantage of it wholly. I recommend that everybody maxes out as much as possible their retirement accounts every single year so they're getting the most tax savings over time. Even if your employer doesn't offer a plan, the IRA is exactly what's there for you. It's your safety net. So you should be investing into that every single year that you're making an income, that you're receiving pay. So there's a good thing about IRAs because a lot of families have a parent that stays home with the children. Maybe you're a full-time stay-at-home mom or a full-time stay-at-home dad. The great thing about an IRA is it has a spousal IRA clause, meaning if you and your spouse file a joint tax return together, you can contribute, as the non-breadwinner, can contribute to your own spousal IRA off of their wages. Now, it's important to remember that if you are married, you have to have separate IRA accounts. You can't have a joint account between them. That's why it's specifically called an individual retirement account. But each spouse can invest into their own individual account, especially with that clause where if you're not making the money, you're staying home with the kids and working really, really hard, and they're out in the office working really, really hard, you can still split that and do the maximum in the breadwinners and the maximum in the homemakers and still get the tax advantage as if you had your own job. So there are 5 main types of IRAs. The first 2 are the most well-known, which is a traditional IRA, a Roth IRA, and we have the spousal IRA, which we just talked about. We have a SEP IRA and a simple IRA. So the most common IRA is the traditional IRA, which means that you're deferring taxes until retirement. So you're actually spending less money today on taxes because you're going, all that retirement money that I'm taking out of my check today and putting towards my retirement fund, I'm not going to pay taxes on it right now. So you're going to overall lower the amount of taxes that you're paying today and still have that growth. The downside with that is eventually you're going to have to pay taxes on the money that you've invested and all of the interest that you've earned on that money invested. Based on your income level, it could be the same or lower or higher than it is in your retirement. So it's kind of a toss-up on whether it's more advantage for you to defer taxes or pay taxes right now. So if you want to pay taxes right now and not have to worry about paying taxes on all the interest that you're going to accumulate over the years, you're going to want to go with the Roth IRA, which is the second most common one, I would say, almost tied with traditional. But the Roth IRA means that you're going to pay taxes on that money right now, which means overall you're going to have less money going towards your retirement at the beginning. But all of that interest that you accrue is going to be tax-free because you've already paid off the initial egg, which is something that I absolutely love. One, because I'm young and I have quite a few years of interest to accrue before I ever get to the point of taking that out in my retirement. So the taxes that I pay right now are probably going to be less just because I'm not making that much money. It's probably going to be less now than it would be in retirement. So for me, I have a split between traditional and Roth. Right now I'm more heavily towards Roth. As we already talked about the spousal IRA a little bit, it's a great tool to be able to use in families where not everyone can work because we're staying home and watching the kids and helping them turn into adults and getting out into the world on their own. So that spousal IRA allows both parties to be able to contribute to their each individual retirement accounts and get that taxable interest and free money basically in the long run with it. Now, a SEP IRA and a simple IRA are leaning towards more of the entrepreneur, small business, solo, joint partnership. That makes sense. A mix of those. So a smaller business. A SEP IRA is also known as a simplified employee pension. This allows small businesses or self-employed individuals to participate in making contributions to employees' retirement accounts. With SEP IRAs, the only way that they can contribute is traditional. So there's no Roth ability with this. All of it's going to be taxes deferred and paid at retirement when it's drawn out. So there is no Roth ability with the SEP. The one catch with a SEP IRA is that each employee that is underneath that company must receive the same proportional contributions across the board. Meaning you can't favor one person over another. It has to be a proportional, even amount spread out through all of those employees. So no favoritism, no great way for a CEO to make a bunch of extra money off their employees, because if they do that to themselves, then they need to do it for the other colleague as well. Now, a simple IRA is also known as a savings incentive match plan for employees. It's specifically for small businesses with less than 100 employees, and those businesses don't really have any other retirement plan options available to them. So if they had a 401k or the ability to do a 401k or a 403b, this wouldn't apply to them. But if they don't have that option, this is a great way for that small business to do it. Again, just like the SEP IRAs, it only allows traditional contributions with the taxes deferred until retirement, but it is generally more cost-effective and easier to maintain for a small employer than a SEP IRA. So when it comes to setting up an IRA, there's a couple different avenues that you can go down. So basically an IRA can be held at any institution that's approved by the IRS to do so, not just banks, which is a common misconception that people have. IRAs can be set up with stockbrokers, with mutual funds, with life insurance companies, and with banks and other financial institutions. The most important thing to remember when it comes to setting up that account is understanding how hands-on you want to be with your retirement funds. And that means, do you want to be the one making the decisions on how your money invested? Or do you want to be able to sit back and say, this is the year that I want to retire, or I'm estimating that I'll start my retirement. Please figure it out for me, make the best decisions for me, and get me the best return that you can until that time. So two big things there: either you're making your own investment decisions or someone else is making them on your behalf. So you've got your IRA set up, you know what you're looking for, you decided whether you're doing Roth or traditional. Now it comes time to actually contribute to your IRA. So you have until April 15th of the following year. So 2021 right now, that means I would have until April 15th of 2022 to make contributions to 2021. So it gives you an extra couple of months to get funds in there every single year. The important catch to remember with that, though, is if you do wait until the start of the next year before contributing, you want to make sure that you've added all of your contributions into your IRA before you file your taxes. If not, you might have to edit your taxes and go through a bunch of hoops to fix that. All retirement accounts have a max contribution limits every single year. It changes and adjusts and usually increases year after year to adjust for inflation and growth in the economy. For 2021's contribution limits to an IRA, if you're under 50 years old, you can contribute $6,000 for the year. If you're over 50 years old, there's a catch-up with that, and you can put an additional $1,000 towards it. So you can put a total of $7,000 towards your retirement fund every single year if you're over the age of 50. With traditional IRAs, it gets a little bit more complicated because there are additional income limits that they slide in there that might limit your ability to contribute to that or limit your ability to get that tax advantage. That is going to be based on your adjusted gross income. I'll do a video on that later. Watch for the link down below on that. So one important thing to keep in mind with investing into your IRA is that those contribution limits also have a negative side to them. You don't want to go over that maximum contribution limit. So 2021 is $6,000. If you went over $6,000, you would be taxed 6% interest on anything that's above that $6,000 for as long as it remains in the account. Which means that if you forget about it, you don't do anything with it, and it just stays in there, you're going to be charged 6% tax on that excess and any interest that that excess acquires over that time frame. There's a couple catches with this on how you can correct it. One of the big ones is you identify that you put in too much and you withdraw it before you file your taxes. That saves you from having to pay that 6% tax on it, and it keeps you at that maximum contribution limit. Another option that you have is actually to roll over that excess funds into the next year's contribution limit. So if you put in $7,000 this year and you're only allowed to put in $6,000, you could roll that $1,000 over into 2022. The catch with that is if you do a big oopsie and say you put in $12,000 or $13,000 and it's more than you can contribute the next year, then you're going to get taxed on that additional excess until you withdraw it. So there's a couple catches with that. You don't want to get charged that 6% tax, so make sure that you're keeping just right at that limit or withdrawing just enough to make sure that you're getting the maximum benefit without getting that 6% tax penalty. Now, when it comes to retirement, there's a couple different specifications on it. You can start withdrawing your funds at the age of 59 and a half, which is fantastic. You don't even have to wait till you're 60 now, and you can start withdrawing those funds. And once you reach the age of 72, you're required to start taking the minimum distribution amount from your IRA, which means you can take the minimum balance and just keep working at it on the lowest level. But you can start at 59 and a half, and you have to by age 72. So that's the basics of an individual retirement account and the 5 different ways that you can go with it: traditional, Roth, spousal, SEP, and simple. They're great tools for you. I highly encourage you to invest in the IRA as well as any employer sponsored plans that you have. I'll do another video that breaks down a bigger difference between Roth and traditional, especially with traditional, with the different income levels and how that impacts your ability to contribute to your IRA. But I hope you start investing. Every tiny little bit helps, especially with compounding interest and just the value of time. So I'll see you next time, guys.